taxpayer-friendly features of the new IRS Tangible Property Regulations. The IRS Repair and Capitalization Regulations, otherwise known as the Tangible Property Regulations, became effective in their final form on September 13, 2013. If you are a tax professional and you have clients that own commercial or multifamily real estate, chances are those clients will be affected by these new regulations. So what are the taxpayer-friendly features of the Tangible Property Regulations, or TPRs, and how do they work? Before looking at some examples, let's review what these regulations are about. Building owners routinely spend money to repair and/or upgrade their buildings. The TPRs are intended to guide building owners and their tax professionals in determining when to capitalize expenditures on buildings and when to expense them. Rather than simply using a fixed dollar amount as the dividing line, as has often been the practice in the past, the TPRs provide a more complex framework for deciding whether to capitalize or expense. At its simplest level, the IRS looks at whether an expenditure is for a betterment or is a straight like-for-like replacement of the building component. If it is for a betterment, such as upgrading old lighting with new, more energy-efficient lighting, then the new lighting must be capitalized. The net depreciable value of the old lighting may be written off rather than remaining on the books as a ghost asset. If it is for a restoration, such as returning a component to its ordinarily efficient operating condition, if the property has deteriorated to a state of disrepair and is no longer functional for its intended use, you must capitalize the replacement. In addition, restoration covers the replacement of a major component or a substantial structural part of a unit of property. If an expenditure is for a replacement, such as putting on a new roof membrane that is equivalent to the old roof, then the TPRs require a determination to see if the new membrane is material. Materiality can be determined by comparing the new membrane's cost to the cost of the unit of property to which it relates. In this case, the building and its structural components. If the new membrane is no more than 30% of the unit of property at the time, then the entire cost can be expensed in the current tax year. The same idea would apply to other building components, such as replacing HVAC equipment, if the activity represents no more than 30% of the HVAC unit of property. How can the tax professional know what the basis of a building component or other unit of property is in order to determine whether a new expenditure is under the materiality threshold? The best way to get this information is to have a unit of property study done by a qualified cost segregation firm. The study will provide you with reliable benchmarks that will withstand IRS scrutiny. A unit of property study can be prepared using data from a cost segregation study, and the two can complement each other, providing benefits of accelerated depreciation and the ability to expense certain costs or to write off replaced assets in the future. In addition, the IRS is expecting almost every taxpayer who owns buildings to file a Form 3115 change in accounting method for the 2014 tax year to adopt the unit of property rules. To summarize, when expenditures are for betterments, restorations, or adoption to a different use, they must be capitalized, but the remaining book value of the old asset being removed may be written off. When the expenditures are for like-for-like replacements, the new asset may be expensed if it is not deemed to be material, meaning more than 30% of its associated unit of property. A cost segregation study with values for the building's unit of property can be used by taxpayers as a reasonable method to assist with materiality testing. Bedford Cost Segregation is working with CPA firms and property owners across the nation to assist them in understanding and implementing the regulations. For more information, contact the Bedford representative that shared this video with you.